Do we have any questions? Yes, we have one right in the middle. Stand up and be loud.
That's the national average for the farmer in that enterprise. That's a good point. I think the main message that I was trying to put out was just looking over time how that financial performance changes more than looking at that particular enterprise. So looking at the financial risk profile from a financial perspective over a 20-year period. But I take on board what you say.
How are we going? David.
Thanks, Mick. To Andrew, your farm sustainability index appeared to me to be entirely geared to grain producers. Do you have something similar, or are you planning something similar for livestock production?
Good question. The model at the moment is just in broadacre agriculture, and the reason for that is that all the actuarial numbers behind the scenes to build everything came from the Canadians, and that's their number one enterprise. Moving forward over the next 2 and 3 years, once we get the data, we will be able to build the model for other sectors. We've already got strong interest in sugar, dairy, and the livestock. Livestock's going to be a little bit trickier than cropping because of the moral hazard that it proposes, because crop's very, very easy to track because it's in and out, whereas livestock, I'll just keep them for breeders. You know, there's all those other issues we have to look at, but certainly possible.
I think he's saying the livestock sector is full of rogues. NLIS to the fore. Any other questions? Yes, we've got one, Jay.
Jay Horton, Strategic Partners. The wine grape industry has a problem which needs a solution. So at the moment in the Australian Wine Industry Code of Conduct, the person who grows the grapes gets 1/3 of their payment 1 month after harvest, 1/3 after 3 months later, and the final third 3 months later again. So what's happening in that industry is I would suggest is that group, the producers who are perhaps least in a position to bear risk, are being asked to subsidise the balance sheets of winemakers. Now, it just seems to me that there's an opportunity for some sort of supply chain working capital product where the producers themselves are not subject to bearing all of that risk, some of which they have no control over.
Oh, valid point. I mean, we've been in high-level discussions with the government, part of their white paper series, and I can say that the government actually is tangibly looking at things to assist in terms of the cost of premiums, but there is certain advantages with people up in the supply chain. They get massive advantage by increased output at the farm gate. So there are some very interesting opportunities available within the supply chain. I agree.
Yeah, Malcolm Wagner from University of Queensland. Andrew, congratulations on being able to bring what looks like it could be a commercially viable insurance product to Australian agriculture. Could you perhaps explain a bit of the background to the Canadian one? They've had 4 years' experience, I hear from you, but beyond that there was a long period of insurance available to Canadian grain farmers where the administrative costs were met by the Canadian government. So they've had some prior experience. how is that going to affect the adoption of their scheme?
Well, effectively, that background in history from the Canadians is what enabled this program to be built, because the programs in Canada, and this model really developed from the black frost that they had in 2004, where the state-based models, because of the way they were triggered, did not actually look after the growers the way everyone thought it was going to. And you have the other issue with the government, which is heavily subsidised by the provincial provinces, that they don't pay very quickly. They change the rules when there's a big payout, so you just cannot rely upon it. And so they're seeing in Canada now quite a rapid uptake in this model, because everyone's getting used to it. And it's like any early adoption like we've seen. We've got the 100-odd people in the program for this year, and when everybody gets comfortable the way it works, because this is a brand new concept, people will tend to use it, because it will enable them to expand their business with comfort. And the other, like I mentioned, it was the higher educated people that took it up first. But literally, I think it was 85% of the people that we've brought into the program are farming more hectares this year than what they did last year. Because they know that if you lease or you share farm, you don't have that balance sheet strength. And that's what this can actually do. If you sit down and you look at the model, you can be a young farmer that actually leases all your farm and still potentially get access to working capital, because you've got a guaranteed insurance. And that's what's really significant, I think, for the entire industry, that this is intrinsically linked with the finance and how we can change the way we're funding Australian agriculture.
David.
David Robinson, AFF. Andrew, what's the rate?
Okay.
The average rate. Don't fudge it by saying it varies.
So the rates this year, so people have paid between $12 and $35 a hectare was the highest. The average premium price was $21.36, I think it was, in real terms, and obviously the coverage to match. And it's a bit hard to quote the average coverage because of the banding flexibility within it. But in terms of if you look at it as a percentage basis, it varies from an effective rate of 5 to 9 of sum insured.
And what's the proportion of cover? 6 on average?
On average. So the way the model is built is that you will qualify for 60 to 80% of your 5-year rolling average.
Right.
Where you fit between that 60 and 80 is basically due to your variability, or the standard deviation from your average. So obviously when you're in the lower rainfall areas that have the highest variability, you need to you'll be offered less on a per hectare basis relative to your average, rather than a more consistent grower that is consistently performing his average.
Yes, the lady.
Hi there, Becca Wilson from Black River. I'm interested, Andrew, in the information that growers are providing you through this process and the quality of that, and also whether that's been any grounds for rejection of policy in terms of people not being able to provide what you require to do the assessment.
Oh yes, data. Don't get me started. It's a challenge. Because we have to get everyone's tax records, then farmers have to do declarations. It is difficult. So the quickest processing was 4 hours, and the longest has been 8 weeks, right? And it all comes down to how organised and structured someone is in their bookwork. And it's very interesting to see the difference. And just because you're a good farmer in the paddock doesn't mean you're a good farmer in the office, is all I'd say.
What, the shoeboxes aren't organised? Where are we? How are we going for questions? Yes.
Andrew, you mentioned savings in your talk. Did I miss it when you said what the savings are?
Didn't mention the word savings, Frank.
You must have misheard, Frank.
What we're saying, so a lot of people choose to take out this policy rather than hail and fire. They also, many people have actually, I must say, have shifted banks and picked up 1.5% interest rate savings. by doing it. So there actually has been some savings relative to your premium price. I suppose the headline act there for farmers is they're choosing to protect their costs in a bad year rather than a bit of profit in a good year. That's their philosophy that they're looking at.
Okay, we've probably, I can see there's a lot of thinking going on. Yes, Mark, down the back.
Thanks, Mick. I just had a question for Adam. You put up some quite interesting analysis on the absolute level of risk in terms of GDP and other aspects of agriculture. I suppose as important as the absolute level of volatility is the correlation between sectors within the industry, and I suppose the high level of risk suggests that the level of correlation at an aggregate level, the individual sectors are fairly highly correlated if you're getting a high level of risk at the aggregate level. But from an investor point of view, I would have thought that the correlation of the volatility in ag with other sectors would be as important as the absolute level.
So you're saying, looking at the different sectors, so the annual output, is that what you're, so that if we were to include the wine industry or what?
Whatever output or whatever measure you're measuring, it's the correlation of that measurement with the equivalent measure in other sectors. So for instance, GDP, agriculture's contribution to GDP volatility, how does that correlate with mining and other sectors? So what's the diversification potential?
Yeah, that's something I think we need to develop. But it is really based on that GDP's trend line, that polynomial trend line over that period. And I agree that it's probably a beta approach that you could take, and I think it would probably make that analysis a bit more robust.
Yeah. How are we going? Yes, there's a question over there.
Thank you. Darren Arney from Grain Producers SA. A question for Matt. With the price risk management tools that you put up on, gave examples of, is the exemption for pools under financial services regulation impacting on the uptake of other regulated products in developing risk management tools or programs for farmers?
Yeah, definitely is. And we're also seeing that with the use of financial products in terms of Dodd-Frank regulations and so on. So yeah, it's a lot of providers are limiting themselves to only wholesale clients because of the risks involved with dealing with retail clients, and that's a shame because it's taking away useful tools for the average size producer, and so that is having an impact, yes.
Okay, look, we're slightly over time getting to lunch, but only 5 minutes, so we haven't done too badly. I certainly think you'll agree with me that this whole issue of risk is a very interesting one, and I thought there were some observations there that transition from statutory and regulated marketing to the open markets that have been evident in the last decade and a half in Australia probably haven't been matched with a transition to better risk management and better information tools to pick up Matt's discussion. So certainly I think that's been an interesting addition to thinking about the options for funding agriculture into the future. So please thank our three speakers for this session.